All right, hi everyone. Welcome to today's live trading session brought to you by IronFX. Right before we start today's webinar, please take note of the disclaimer, the risk warning, as you can see here. Right, this information is not considered as investment advice or investment recommendation, but instead it's just marketing communication. Also, take note that all the products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Right. My name is Ketan Ramachandra, and this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, before we dive into the charts on TradingView, we're going to take a look at what's up on the calendar, for, what's remaining on the economic calendar for the rest of this week, right? There's quite a few important things going on, right? We have the Bank of England releasing its monetary policy statement later today. That's on 6th of February, followed by unemployment claims from the US. And tomorrow, we have the highly anticipated non-farm payrolls and unemployment rate being released by the Bureau of Labor Statistics, which is the BLS, and we're going to see this tomorrow at 1:30 p.m. GMT time. Now, here's the calendar for Thursday and Friday. Right, so at 12 p.m. GMT, the Bank of England will release its statement, where they're widely expected to make a 25 basis point reduction in the official bank rate to bring it down to 4.5%. After that, at 1:30 p.m. GMT, we have unemployment claim for the US. And then tomorrow, Friday, 7th of February at 1:30 p.m. GMT time, the non-farm payrolls, the BLS will release its employment report, where we'll get an insight into the non-farm payrolls and the unemployment rate. Right, this is going to be probably the most highly anticipated data event of this week. Now, coming back to the Bank of England, right? The previous meeting for the Bank of England took place in December of 2024, where they kept rates on hold at 4.75%. Right. So back then, right, there was some concerns that inflation, wage growth, and other indicators of inflation expectations had risen. Hence, they kept rates steady. However, since then, right, we've seen wage growth sort of slow down. The labor market is weaker now, as well as seen in the latest labor force report. And also, demand is sluggish as well. Hence, the Bank of England is now ready to move ahead with a rate cut later today. Right, so markets are pricing in a 25 basis points reduction, and we can see that looking at closer look at inflation, right? Although headline CPI, which is the chart on the left, sits at 2.5%, and the core CPI sits at 3.2%, both of which are slightly above the Bank of England's target of 2%, right? However, because due to the weakening labor market and sluggish GDP activity, right, economic activity, the Bank of England looks set to move ahead with the rate cut despite inflation being slightly above its target. However, they're expecting inflation to moderate lower over the next coming months, which is why they've decided to, which is why very likely they will move ahead with a rate cut later today. Right, and when we look at the labor market data on the left, we have the chart for employment change, which shows the rate of job increases slow down quite significantly from August till November. Right, in November, we only saw about 36,000 jobs being added to the UK's labor market, a very weak figure, as compared to what we saw around June to September or June to October. And then on the other end, at the same time, we've seen the unemployment rate, which is the chart on the right, increase from 4% in August to as high as 4.4% in November. So while the rate of job growth has slowed down significantly, the unemployment rate has moved up as well, right, signaling a weakening labor market. Right, so and combined with sluggish economic activity, we can expect the Bank of England to move ahead with its rate cut later today, which is likely to put some downward pressure on the pound. Now, coming to the US, right, unemployment claims will be released at 1:30 p.m. GMT time, right? So this is a data point, a weekly data point that tracks the number of the number of Americans that are filing for unemployment benefits, and typically a rising number, as what you see here from May till July of 2024, signals weakness in the US labor market. So the more claims that we have, obviously the trajectory of claims rising, climbing higher, it signals a weakening labor market. And on the flip side, as what we see from September to now, declining claims signal some stability in the labor market. So with claims continuing to trend lower, right? This is usually bullish for the US dollar. So for last week's reading came in at 207,000, well below the 12-week average of 218,000. And the forecast for this week sits at 214,000, a slight uptick from last week's result. Nevertheless, it still sits below the 12-week average. So should we see claims uh, come in lower than the forecast once again, right, showing a continued downward trend, this could likely function as a bullish catalyst for the US dollar, right? So once again, right, the forecast for this week sits at 240,000. And if claims come in much higher than the forecast, this is typically going to be bearish for the US dollars because remember, higher claims signals weakness in the labor market, which in turn would be bearish for the US dollar. And hence, that in turn could push currency pairs like the euro, pound, Aussie, and Kiwi higher, along with gold prices as well. So falling dollar is likely to push this asset classes up. Now, if claims come in much lower than the forecast of 240,000, that means we have less Americans filing for unemployment benefits. This signals a much more stable and robust labor market, and that in turn is likely to be bullish for the dollar. So that would mean the opposite, of course. So euro, pound, Aussie, Kiwi, along with gold prices, should fall, right? And once again, the 12-week average sits at 218,000. Now, coming to the Bureau of Labor Statistics, right? They will release their employment report on tomorrow, Friday, 7th of February at 1:30 p.m. GMT time, right? And the unemployment rate has been pretty steady since September till December, right, coming in between 4.1 and 4.2%. And we can see that the unemployment rate is expected to remain unchanged at 4.1% once more in January 2025. So remember, these results that we see here tomorrow would be for January 2025. Now, at the same time, we can also see non-farm payrolls, which is the chart on the right, increase quite strongly or rebound quite strongly in November and December. Right, we can see that the last 2 months, the data for the last 2 months rebounded strongly and have printed above the 12-week average of 186,000. However, for the forecast for January, we are looking at about 154,000 being 154,000 jobs expected to be added to the US labor market, right, which is going to sit below the 12-week average. So a relatively lower figure as compared to November and December. Now, how can we interpret this data point, right? If we see the unemployment rate edge higher, right, unexpectedly edge higher to 4.2%, while non-farm payrolls comes in lower than 154,000, right? This type of result is likely to function as a bearish catalyst for the dollar. So take note, a weaker change in non-farm payrolls and a higher unemployment rate is likely to function as a bearish catalyst, causing the dollar index to fall and push the other currency pairs higher. Now, on the flip side, right, should we see a robust report for the month of January, right, we can definitely expect strong bullish activity for the dollar. Now, yesterday, which was Wednesday, 5th of February, we had the ADP release its employment report, which showed very strong job growth for the private sector. If that's an indication for what we can expect tomorrow, maybe it's something that we can take note of. Because remember, over this period, right, which is December to January, right, December to January, we've also seen unemployment claims trend lower, right, which is a signal, which is typically a sign of labor market stability, labor market strength. So that could be that we may see, right, non-farm payrolls come in stronger than expected, especially since this week's ADP data also came in strong, right? Wednesday's ADP data came in much stronger than expected, right? And maybe that's a sign of something to that we can expect for tomorrow for the non-farm payrolls. All right, now we're going to now let's head on over to the charts and trading view and begin the analysis on the dollar index starting on the daily time frame. Right, we'll work our way through some of the major currency pairs. We'll definitely be touching on cable, which is the British pound, US dollar, since we have the Bank of England coming up quite shortly. Right, I think in less than an hour, the Bank of England will release its statement. Then we'll look at a couple of the other major currency pairs, the commodities, the indices, and of course, any other requests that you have. Right, so please do not hesitate to drop your requests in the chat box here. Right, drop your request as soon as possible, right, as early as possible, so so we can go through the analysis together. Don't wait till the end to drop your request, as we may not have time to go through it together, right? Okay, so let's start with the dollar index. And we can see here, right, since October, since end of October, since end of September, early October 2024, the dollar demand for the dollar has increased significantly, with dollar index rising as high as 110.17 on Monday, 13th of January. This is a huge move to the upside, right, with the dollar index gaining, I think, well over 10% from the trough to the peak. And we can see here from trough to peak, it has gained up 10%, right? A huge move for the dollar index here. And over the last few weeks, we've seen it pull back, then move higher again, and then swing down again, right? We've seen a lot of increased volatility due to several factors, right? We've had uh, US, we had the US government, right, announced trade tariffs against countries such as Canada, Mexico, and China, right, over the weekend, over last weekend, right, which caused demand for the dollar to spike on Monday. However, the dollar index stalled at around 109.80 before reversing, because after that, later on that day, late on Monday, US President Donald Trump came out to announce that he's giving countries like Mexico and Canada a 30-day suspension as they negotiate uh, the trade deals and other border issues, right? So because of that, right, the trade tariffs were not implemented on Tuesday, 4th of uh, February, right? So basically on the 1st of February, which was Saturday over the weekend, right, the White House had announced that they were going to impose the trade tariffs on Mexico, Canada, and China, which is why when markets opened on Monday, 3rd of February, demand for the dollar spiked, causing a huge surge to the upside. And then later on Monday, and this uh, tariffs was meant to go into effect on Tuesday, the next day, 4th of February. However, towards the end of Monday, President Trump came out to announce a temporary suspension, right, a 30-day suspension for Canada and Mexico. That is why we saw the dollar sell off as trade wars tensions, right? Trade war tensions sort of de-escalated a little bit. However, you can see volatility for this index remains high, and the dollar index has managed to stabilize at around 107.60. Yesterday, 5th of February, right, closing at around 107.60, and looks to have made a pretty decent rebound today, right? So with regards to the support and resistance levels, right, first resistance can be, one of the resistance levels can be identified at 109.96, right? We just see a swing high taking place here on 10th of Jan, right? We see a swing high taking place here on 10th of Jan, and another resistance here on the 3rd of February, right? So this creates a multi-swing high resistance at 109.96. Now slightly below, right, slightly below, I see a pretty decent pullback resistance as well, right? This level here previously, this level at 108.95 previously functioned as a pullback resistance, right? And then once this price is hit here, it creates a pretty decent overlap. Of course, we can see this wick here rising beyond the overlap at 108.95. That's why this level here, I'm going to be identifying it as an intermediate resistance, right? I'm not going to identify it as the outright first resistance, more of an intermediate resistance because of this spike exceeding 108, exceeding the 109 level. So that means this multi-swing high at 109.96 is where I would identify the first resistance. Now looking at support, we can see that if we go back to the chart on 22nd of November, 2024, we can see that the dollar index made a swing high resistance here on 25th of November. And then once the bullish breakout took place on 18th of December, this level function is pretty decent support all the way till today, right? When I draw a horizontal line, now when I draw a horizontal line at 107.49, we can see that this is a pretty decent support area, right? We can see, of course, this candle here on Monday, 27th of Jan, the wick dropping well below this level, the overlap level, but generally we can see that this level has managed to function as pretty decent support for the dollar index this week, right? And we also had the green Ichimoku cloud function as an area of support. Remember, when the Ichimoku cloud is green in color, it highlights the ongoing bullish momentum And at the same time, the cloud itself, right, the top of the cloud or the zone within the cloud can function as an area of support as well. So in this case, we had the overlap level and the Ichimoku cloud itself, helping us to identify a potential support area, which has played out quite nicely yesterday, 5th of February, and today as well. Now, on this uptrend that begins from here on 6th of December, we can run a Fibonacci retracement from this swing low to the swing high here on 13th of Jan. When I look at all the fibs, we can see that 61.8% sits just underneath the overlap level here. So let's keep 61% on. And at the same time, starting from this swing low here in September, we can run another Fibonacci retracement from 27th of September, going up to this high here on the 13th of Jan. When I look at all the fibs, let's see, 23 has already surpassed, 30 is fine. All right, that's fine. We don't need to use the other retracements for now, right? So these are the first and support and resistance levels for the dollar index on the daily time frame, right? And it looks to be rebounding higher. And remember, if we do see the unemployment claims come in lower than the forecast, right? If it's lower than the forecast, this is typically going to function as a bullish catalyst for the dollar. So that may cause the dollar index to rise a little bit higher as well. So if we do see the dollar index get a nice bump and move higher, where I would identify a potential take profit target for the dollar index would be in this resistance zone here and around 108.70 to about 108 to about 109, right? 108.70 to about 109 is where I would identify a potential take profit target for the dollar index if we do see the unemployment claims function as a pretty decent bullish catalyst for this index here. Now let's move on over to the 4-hour time frame, right? Let's move on over to the 4-hour time frame for the dollar index and see if there's a need to fine-tune the analysis. Now on the 4-hour time frame, we can see there's a nice downtrend here that begins from this swing high on 3rd of February, going down to this swing low here on the 5th. And we can see here that this resistance zone is sort of accompanied by the Fibonacci retracements at 50 and 61.8%. So let's keep these two retracement levels on, right? And we can see here we have a pretty decent resistance barrier here, right? So this would be a good place to identify the take profit target. Should we see this rebound in dollar index gain further traction? So that means anywhere from 50% retracement and above, so basically about 108.60 and above, would be a good area to a suitable area to identify a take profit target for any continued bullish movement for the dollar index. All right, I think there's nothing much else to tweak. I think what we've identified on the daily time frame is more than suitable for the dollar index on the 4-hour time frame. So take note, unemployment claims could function as a pretty strong bullish catalyst, a near-term bullish catalyst for the dollar index. And if that were to happen later today, right, I think identifying a take profit target in this zone here would be a suitable area to do so. All right, then now let's move on over to cable, right? Cable is British pound, US dollar. And since the Bank of England is coming up in about 45 minutes or less than 45 minutes, let's identify the key support and resistance levels. Now, the Bank of England is expected to make a rate cut, so that would typically mean it's going to be bearish for the pound. So we can expect this currency pair to drop lower, right? We can already see cable has reversed off today's high at about 1.2503 and it's dropped down to under 1.2450. Now, when the rate cut takes place, right, it's quite likely that uh, this currency pair could drop a little bit lower. However, the statement is going to be important as well. The contents of the statement is going to be very important because if the statement doesn't project a very dovish outlook with regards to future monetary policy action, that means the initial drop in this currency pair could stabilize and maybe make a retracement to the upside, right? So despite the Bank of England moving ahead with a rate cut, the statement is going to be equally, or if not going to be more important than the decision itself, because if we do see a statement that's somewhat more balanced in its outlook, that means we could see any initial drop stabilize and perhaps make a retracement. However, if we do see a statement that also conveys very dovish language, very dovish communication, right, that could function as an additional catalyst for the cable to drop even lower, right? So where I see a nice support, the first support for cable, right, would be at this level here at 1.2307. This is where I would identify the first support. So that means if you are going to short the cable, right, in anticipation of the rate cut, right, where I would identify the first take profit target would be close to 1.2307. And of course, should this currency pair continue to slide even lower, I'll be identifying the second take profit target at this other significant swing low that has taken place here on 15th of Jan, which is at 1.2162. Now, in terms of resistance, right, I can see that cable has sort of run into resistance at 1.2497, right? This looks like a pretty good overlap resistance, right? We can see support here on 9th of May, support here on 22nd of May, on November, sorry. So let's start again. Support here on 9th of May, swing low support here on 22nd of November, and support here as well at the end of December. And then we see resistance in the first and second week of Jan. We see resistance once more in the last week of Jan. And of course, we see resistance this week as well. So this highlights a very significant overlap at 1.2497, which we can identify as the first resistance. Right, for now, right, this currency pair is pulling back, right? And of course, when that rate cut takes place, it's quite likely it's going to drop further. And also, if we do see a statement that conveys a dovish outlook with regards to future monetary policy action, that could act as a further bearish catalyst for this currency pair. And if it were to drop lower, I would identify the first take profit target at 1.2307, right? A nice swing low here taking place on 31st of January, or sorry, taking place earlier this week. And of course, should price continue to drop even lower, I would be targeting the second swing low here that occurred in mid-Jan, and that's at 1.2162. Now, on this big downtrend here, we can also run a Fibonacci retracement starting from this swing high, 26th of September, going down to the swing low on the 13th of Jan. When I look at all the fibs, right, we can see that 23.6% has already been surpassed. That's fine. We're not going to use it. However, I would like to identify this overlap level here, right? It's a pretty decent overlap level at 1.2602, which is accompanied by a Fibonacci retracement at 38.2%. Right, we can see this level previously functioning as support here on 16th of December, and then resistance here at the end of December, creating a pretty decent overlap that's accompanied by the 38.2% Fibonacci retracement. Right? In fact, I can even stretch it all the way till here. All right. So these are the key levels for cable on a daily time frame. Let's move on over down to the 4-hour time frame and see if there's a need to fine-tune the analysis. I think this is pretty much okay, right? I don't think there's anything else that I would like to highlight. Perhaps maybe on this uptrend here, right? On this uptrend here, we can run this Fibonacci retracement from this swing low on 3rd of February going up to this, We'll run a Fibonacci retracement from this swing low on 3rd of February to the swing high here on the 5th. When I look at the 50 and 61.8% retracements, right, we can see a little support level here, right? This is not going to be the strongest support level, but nevertheless, I would like to bring your attention to this little pullback, right? We can see, right, cable finding support here on 29th of Jan, then once again on 31st of Jan, then it breaks lower, breaks higher, finds support once more on 4th of February. So not the strongest pullback support level, but something to take note of as well. Because if this zone here, right, that's identified between the 50 and 60% Fibonacci retracement, if this zone here fails to hold up, cable is very likely is going to make a good run towards the first support. Okay, on the 4-hour time frame, first support, I would adjust it just a little bit lower to 1.2250. Okay, so take note for the 4-hour time frame, you can see we are matching the support to the body of the candle here and this swing low here. In fact, it actually looks like a very nice overlap resistance on the 4-hour time frame, right? We see resistance here in mid-Jan, support in the 3rd week of Jan, and then support once more. Swing low support here on 3rd of February. So on a very nice overlap level at 1.2246, which we can identify as the first support. So once again, this currency pair is falling lower today, right? It's already falling lower today. And with the rate announcement being going to be released in about 30-35 minutes, it's widely expected the Bank of England will cut its official bank rate which would add further downward pressure on this currency pair. But take note, the statement is going to be equally, or if not more important than the decision itself. Because if that statement conveys a fairly balanced language, right, that means the initial drop in cable could potentially stabilize, right? And maybe we would find this currency managing to find support. However, if the statement also shows or highlights very dovish language, that means this currency pair is likely to fall lower, and especially if it manages to break through the 50 and 61.8% support zone here, then definitely we're going to be targeting 1.2246 as a potential take profit target. All right, so we've covered dollar index cable. Let's move on over to the commodities, starting with gold. And let's start on the daily time frame. And we can see here yesterday, Wednesday, 5th of February, dollar index, sorry, spot gold prices, right? This is spot gold, making its latest intraday high at $2,882.31 per ounce here, and is pulling back slightly as we speak. Now, when I look at this swing high here that has taken place in 30th of October, right? This was previously the intraday all-time high, right? Which served as a pretty strong resistance on 24th of Jan, and then proceeded to function as pretty good support on 4th of February. So this is where I can identify a support level for spot gold. So let's draw that horizontal line now. Right, you can see here, resistance here on 31st of October, resistance once more on 24th of Jan, and pretty good support here on 3rd of February, creating a very nice overlap, which we can identify as the first support. Now, on this uptrend here that begins from 19th of December, we can also run a Fibonacci retracement starting from this swing low, 18th of December, going up to the intraday all-time high of yesterday. When I look at all the fibs, right, I can see 38.2% retracements sit just below the overlap level. So let's highlight this as a zone, and a little bit below, I can identify another nice overlap, right? When I look at 2,715, I see another nice overlap here because there's resistance. There's support being formed on 23rd of October. After that, we see resistance here on 7th of November, swing high resistance on 25th of November, another swing high resistance on 12th of December. Then we see resistance here again on 16th and 17th of Jan. So this indicates a pretty significant overlap that we can identify as the second support. And it's also accompanied by a Fibonacci retracement at 61% just underneath it. So we're going to keep 30 and 61.8 and then highlight the respective supports as a zones, right? Okay, now that we've identified support and resistance, we've identified the two support levels. Let's take a look at resistance. Now, I can also identify a very nice bullish channel here for spot gold, right? Starting from here, 30th of December, right? It's actually more of starting, okay, hang on a bit. It's actually starting from here, the bullish channel, 6th of Jan. Okay, it's not so much of a nice bullish channel now, but rather of an ascending trend line. Previously, it was a nice bullish channel here, right? There's a nice bullish channel here until the breakout took place on 4th of February, right? But for now, it's not really much of a channel, but rather it's a very significant ascending trend line, which has been respected several times since 13th of January. So we have the intersection of the ascending trend line, the overlap level at 2,787, and the 38.2% Fibonacci retracement, identifying a strong support zone. Right, but however, I want to mention the first support zone is likely to be along the ascending trend line, because we can see that spot gold has bounced off this ascending trend line several times. Right, you can see here a bounce here on 14th of Jan, another second one here on 20th of Jan, third one and fourth one here towards the end of January, and then another nice one on 3rd of February, beginning of this week, Monday. You can see several times, right, where gold has rebounded off this ascending trend line. So once again, the first area of support for gold, it's going to be along the ascending trend line. So if we do see this pullback deepen further, I'll be looking to see if gold can stabilize along this descending trend line. If it does, it helps us identify a buy opportunity, right? So take note, there's a potential buy opportunity. Should we see gold pull back all the way to this ascending trend line, stabilize just above it, and then make a nice bullish reversal. So this is where I would identify a potential long entry for gold. Right, okay, and as I mentioned, we're going to be looking at resistance as it made its intraday all-time high yesterday at around at 2,882, right? Where I would identify the first resistance would be here. I'm using the body of the candle here at 2,856. This is where I would identify the first resistance and highlight this as a zone here. And with regards to the second resistance, I'm going to be using a Fibonacci extension. To find that extension level, I'm going to be running a retracement from here, this swing high on 31st of October, going down to the swing low on the 14th of November. Key extension levels sit at 127 and 161%. And we can see that price has already climbed above the extension at 127%. So this extension is no longer valid. So that means we can only use the 161%. So I'm going to be using, of course, this extension to identify my second resistance, and that's at $2,946 per ounce here. Right, so these are the key levels for gold, spot gold on the daily time frame, right? And once again, this ascending trend line is going to be very critical. And if prices do manage to stabilize above or close to the ascending trend line once more, it helps us identify a good opportunity to go long. Now let's move on down to the 4-hour time frame. Oh wait, sorry. Oh yes, that's right. Let's now move on down to the 4-hour time frame and see if we need to fine tune the analysis. Right, okay, you can see here, right, on the 4-hour time frame, we would be using the body of the candle to identify the resistance zone. And it's pulling back here. So you can see even on the 4-hour time frame, the gold is continuing to trade above the green Ichimoku cloud. The cloud is right. Identify another opportunity to go long. Right now, on this uptrend here, we can probably run another Fibonacci retracement, right? Starting from this swing low on 27th of Jan, going up to this swing high here on the 5th of February. When I look at all the fibs, we can see that the